Today we will analyze the long overdue comeback of boring down-to-earth value stocks, why it's not too late yet, what value stocks can offer, and how to invest best. Additionally, we will discuss the past week's hikes, which value stocks to watch now, and where bargains might still be found. As value investor Seth Klarman once wrote in Security Analysis, "You may not get rich quick, but you will keep what you have, and if the future of value investing resembles its past, you are likely to get rich slowly." Flashiness is usually the right term to describe highly hyped growth stocks such as the Magnificent Seven. The more surprising it is to see boring company stocks jump again, like Procter Gamble, Colgate-Palmolive, or Coca-Cola. As we already discussed in another video, value stocks like Coke embody stability, paying a dividend for 105 years with an increase streak of 63 years. That means Coke has paid dividends since 1962. But here's the key point. They have increased dividends every consecutive year since 1962, and they have no plans to stop. This behavior is typical of so-called quality stocks, which also represent the essence of value investing. They uphold consistent standards, something hyped stocks rarely maintain, as they focus on short to mid-term attention and yield. The Intelligent Investor by Benjamin Graham is one of the foundational handbooks for humble, long-term investing. As Buffett wrote in his preface, "I read the first edition of this book early in 1950 when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is." Graham defined many rules for the defensive investor. For instance, he advised 4 rules for common stocks. Number 1, there should be adequate, though not excessive, diversification. As we aim to do stock selection for a particular part of our invested capital, with most of it invested long-term in world ETFs, we should limit our diversification in stock selection. Number 2, each company selected should be large, prominent, and conservatively financed, meaning we should exclude very small or newly established companies. Number 3, each company should have a long record of continuous dividend payments, like Coke, a dividend king with more than 63 years of continuous dividend growth. And rule number 4, the investor should impose some limit on the price paid for a stock in relation to its average earnings over, say, the past 7 years. Graham suggested that this limit be set at 25 times those average earnings and not more than 20 times the last 12-month period. Here Buffett's lifelong friend and investment partner Charlie Munger comes into play. Munger focused not purely on value but also on quality. He once said, "A great business at a fair price is superior to a fair business at a great price." One recent example is Colgate-Palmolive. The company has paid uninterrupted dividends on its common stock since 1895 and joined the club of dividend kings, having increased its dividend for over 54 years since 1971. Since September 2024, Colgate-Palmolive stock tumbled as inflation shifted consumer spending towards no-name alternatives, bottoming in November 2025 with a total decline of 30%. The price-to-earnings ratio fell from 31 to 21. In terms of value investing, it's fair to pay a small premium, say around 5% compared to Graham's recommended 20 PE ratio, given that Colgate-Palmolive is a top-tier quality stock in Munger's sense. Paying a modest premium while maintaining enough margin of safety seems like a fair deal to us, which is why we opened a small position last year. This appears to be paying off as Colgate-Palmolive rallied 21%, primarily thanks to resilient revenue growth of over 7%. Another candidate is Procter Gamble, showing a similar pattern with 20% decline between November 2024 and December 2025, dropping to Graham's threshold of a PE ratio of 20 in both December 2025 and January this year, and now steadily rising again to a PE ratio of 22. A slightly riskier candidate is Kimberly-Clark, which fell at a PE ratio of about 17, but recently rose again to 20 after weaker earnings. The stock has declined further since announcing the acquisition of Kenvue, which added some legal risk due to the recent Tylenol headlines. Kimberly-Clark has been paying dividends since 1930 and has increased them annually since 1972, making it a dividend king as well. Moreover, the dividend yield currently sits at hefty 5%. With a payout ratio of 82% in line with peers like Colgate-Palmolive. That means 82% of earnings are paid out as dividends, while 18% are used for reinvestment and growth. Another candidate currently valued near its pandemic level lows is Canadian National Railway, whose stock dropped by 20% from its 2024 peak. With a PE ratio around 17 to 18, it's trailing its 10-year median of 20, pays a solid 2.65% dividend and maintains a low payout ratio of 46%. Additionally, Canadian National Railway is a dividend aristocrat with over 25 consecutive years of dividend increases since its IPO in 1995, making it a perfect value bargain in our view. Thanks for watching and see you in the next one.